Ever feel like managing your money is less about strict math and more like trying to find your way through your shit through ways?
Chuckles lightly. Yeah, I think a lot of people feel that way.
You know, you're trying to save, maybe borrow some money, plan for retirement, way off somewhere, but everything, interest rates, world events, it just keeps changing the game.
It really does. The financial landscape is, well, it's always moving. And figuring out how those big shifts affect your own wallet, that's crucial.
Exactly. And that's why we're doing this. Welcome to the deep dive. Our whole mission here is simple. We take a bunch of sources, you send us articles, research bits, commentary, and we pull out the really important stuff for you.
Think of it as your shortcut. You get the key takeaways without wading through everything yourself.
Today, we're digging into a set of recent insights all about consumer finance.
Yeah, this batch comes from the Consumers 360 News Commentary, which pulls from the consumers.app news aggregator. And this snapshot is from June 10th, 2025.
So we're going to unpack what these sources are saying about, well, everything from making your savings work a bit harder, understanding loan costs, to navigating really big life moments like retirement.
And even divorce, which has huge financial implications.
Right. Let's just jump right in, shall we?
Absolutely. Lots of good practical stuff here.
Okay, first up, the absolute basics, your savings account. Most of us have one, right? But how do those big economic things, like what the Federal Reserve does, actually trickle down to the interest you earn? Our first source, a headline from AOL, asked exactly that. How the Fed rate affects your savings, what to expect from every type of bank account.
Okay, so what the research really zeroed in on is that connection, especially with high-yield savings accounts. It's pretty direct.
How so?
Well, when the Fed changes its main interest rate, the one banks use with each other, it tends to ripple outwards. Banks, particularly with those high-yield accounts, often adjust their rates in response.
So Fed raises rates.
You're likely to see better returns on your savings eventually. And the opposite is true, too. If the Fed cuts rates, your earnings might dip.
Okay, so maybe not instant, but high yields tend to follow the Fed's lead. What else did the research say influences those rates? Anything else?
Yeah, an interesting point was about banking competition. In places with more banks competing locally, the sources suggested savings rates tend to be a little bit higher.
Because they're fighting for your money.
Pretty much. They want your deposits, so they might offer more and maybe react faster to Fed hikes to stay competitive.
That's interesting. So where you actually live and bank could make a small difference.
It could, yeah. And another factor, maybe less obvious, is reserve requirements.
What are those again?
It's the minimum cash banks have to keep on hand, stuff they can't lend out. If those requirements go up, banks have less money to lend.
Which could mean?
Well, it might indirectly push them to offer slightly lower rates on savings just to manage their own books. Lower requirements could, free them up a bit. It's kind of a behind-the-scenes thing.
Gotcha. Now, the sources also mentioned something a bit different, right? An alternative way to save.
They did, yeah. Prize-linked savings accounts.
How do those work?
Instead of getting, say, a guaranteed interest rate, your deposits get you entries into drawings for cash prizes.
Like a lottery.
Sort of, yeah. The research noted that while they aren't everywhere, they show some promise, especially for folks who maybe aren't super motivated by tiny interest payments, but like the chance of winning something bigger. It kind of gamifies saving.
Totally different approach. The sources also touched on the Fed's communication style affecting markets.
Right, and how rate changes hit bank stocks, especially those relying heavily on uninsured deposits. Just context, really, showing how interconnected it all is.
So putting it all together, Fed rates, competition, these other factors, what's the practical takeaway from the research for someone trying to get the most out of their savings right now?
The main strategy seemed to be actively look for those high-yield accounts, specifically at banks, that tend to react quickly when the Fed raises rates.
So do your homework on the bank's history.
Exactly. Compare how they've responded in the past. And also, diversification came up. Maybe don't keep all your savings in one single place, just in case one bank or account type lags behind.
Okay, that makes sense. Shop around, check their track record on rate hikes, maybe spread it out a bit. Good advice.
Seems sensible, yeah.
All right, let's shift from general savings to a really common dilemma. You've got a lump sum, say $20,000, where you put a CD or a high-yield savings account.
Ah, yes, the classic question.
CBS News had a headline right on this. $20,000 CD versus $20,000 high-yield savings account. What to consider right now.
And the research laid out the main trade-offs pretty clearly. A CD certificate of deposit is basically locking your money up.
For set time.
Exactly. Could be months, could be years.
Mm-hmm.
In return, you get a fixed interest rate, often a bit higher than standard savings. But the catch is, if you need that money early,
Penalty time.
usually, yeah, you lose some interest, maybe even principal in some cases. Liquidity is what you give up.
Okay. And the high yield savings account.
That's all about flexibility. You can take your money out whenever. But the interest rate isn't fixed. It moves around with the market, with Fed rates like we just talked about.
Right. Variable rate, easy access. Both FDIC insured, though.
Typically, yes.
Yeah.
That safety net is usually there for both, up to the limits.
Okay. Fixed versus variable, locked versus flexible. How do things like current interest rates and economic forecasts play into choosing?
That's really the key thing, according to the commentary. If rates are super high right now, locking that in with a CD can look pretty good, assuming you're sure you won't need the cash.
Makes sense. Lock in the high rate.
But if the general feeling is that rates are likely to go up soon,
Then maybe you want the flexibility.
exactly. A high-yield account's rate could rise with the market. Plus, you keep the option to move your money if an even better rate pops up somewhere else. You're not stuck.
So it really boils down to your prediction about rates and how likely you are to need that money unexpectedly.
Pretty much. The research framed the risks as sort of opposites. High yield, risk of rates falling. CD, risk of needing the cash early or missing out if rates climb after you're locked in.
And the research also mentioned financial planning in this context.
Yes, definitely. It stressed that talking to a financial planner can be really helpful here. They could look at your specific situation, your goals when you might need cash, their own view on rates, and help you weigh those pros and cons.
Right, because it's not the same answer for everyone.
Not at all. Your personal circumstances really matter. And the commentary did note that planners can be especially valuable in, just preserving assets when the economy feels uncertain.
Makes total sense. Oh, and digital banking?
Yeah, the sources pointed out that, thankfully, online banking makes it way easier now to compare CD rates, compare high-yield rates, open accounts, manage both types. Technology definitely helps.
Good point. Okay, let's switch from saving to borrowing. Big topic, mortgages. Our next source, from innews.co.uk via MSN, had a headline that sounds a bit confusing. Why some mortgage rates are dropping and some rising ahead of interest rate decision. How does that happen? Rates moving both ways before an official decision, like from the Bank of England.
Yeah, that headline really captures a weird market quirk, doesn't it? So the research explains that central banks, like the Bank of England, obviously base their official rate decisions on economic data, trying to hit an inflation target, usually around 2% in the UK's case.
Right.
But the mortgage market doesn't just wait patiently for the announcement.
But you'd think they'd all be anticipating the same thing, wouldn't you? Move in the same direction.
You'd think. But the sources suggest it comes down to market speculation and what individual lenders decide to do. Lenders are constantly trying to guess what the central bank will do based on the economic tea leaves they can read before the meeting.
So different lenders might guess differently.
Exactly. Or they might interpret the data differently or have different risk appetites. So some might nudge their rates up preemptively if they strongly expect a hike is coming. Others might slightly lower rates, maybe to grab some business before a potential hike, or if they think a pause is more likely, or just to undercut competitors.
So it's like a prediction market playing out in real-time mortgage offers.
Kind of, yeah. It's lenders positioning themselves based on their best guess. And the commentary noted that for the UK in 2025, things like ongoing inflation and global economic wobbles just add to that uncertainty, feeding those different expectations.
Fascinating. The research also had that slightly counterintuitive point about bank competition and loan rates in the euro area.
Oh, right. That was interesting. It found that more local banking competition was actually linked to slightly higher household loan rates.
Which is the opposite of what you'd normally expect.
Totally. Usually more competition means lower prices. The research didn't pin down one single reason, but suggested things like branch density or maybe local regulations could play a role. It just shows competition dynamics aren't always straightforward.
Definitely a head-scratcher. Good reminder that finance isn't always simple logic. And the sources also briefly mention how rates affect businesses, too.
Yeah, just a quick note that these interest rates obviously impact companies' decisions about borrowing, investing, funding growth. They affect the whole economy, not just us as consumers.
Okay, let's zoom out again. Bigger picture, major life events. First stop, retirement planning. An Investopedia piece on MSN was titled Future Safe Finances: How to Protect and Grow Your Income in Retirement. What did the research say about future-proofing?
Well, several key strategies came up. Diversification was huge. Not putting all your retirement eggs in one basket. Spread investments across different asset types to lower risk.
Makes sense.
Also, regularly reviewing your plan. Retirement planning isn't a set it and forget it thing. Your life changes, markets change, so you need to adjust.
Keep checking in on it.
Exactly. And setting clear, realistic goals for saving. Plus, really maximizing those tax-advantaged accounts, 401k, IRAs, that kind of thing. Those are the building blocks.
And didn't the sources mention a big shift in how we save for retirement now?
Yes, a really important one. The move away from defined benefit plans, old school pensions, where your employer guaranteed an income.
Right. My grandpa had one of those.
Towards defined contribution plans, like 401k. The research really emphasized that this puts way more responsibility and also the investment risk squarely on the individual. You have to manage it.
So you need to be much more involved and informed than maybe previous generations did.
Absolutely. Financial literacy and staying engaged with your plan are critical now.
What about deciding when to actually retire? Any insights there?
Yeah, the sources indicated it's a balancing act. You look at your accumulated wealth, what income you expect in retirement, maybe Social Security, any remaining pensions, and, of course, your personal preference for lifestyle.
Finding that sweet spot where the money lasts.
Right. And interestingly, factors like life expectancy estimates can even influence the timing and how you plan withdrawals.
And once you're retired, the risks don't stop, right?
Definitely not. The research highlighted key ones. Market downturns hitting your portfolio, inflation eating away at your spending power.
Inflation's a big one.
Huge. The sources suggested things like treasury inflation, protected securities, DPS can help there. And then there's longevity risk, just the chance you live longer than expected and outlive your savings.
Wow, okay. How do you deal with that?
Well, having a sustainable withdrawal plan is key. Diversification helps buffer market swings. And for longevity risk, the research mentioned things like annuities, which can provide income for life, as one potential tool.
A whole toolkit needed. And they mentioned PRSAs too.
Yes, personal retirement savings accounts, noted as being flexible, tax-efficient options, particularly good for people without workplace plans, like if you're self-employed. A way to build savings alongside maybe state benefits.
Okay, retirement, that's one massive financial transition. Let's talk about another, often much more difficult one. Divorce.
A tough topic.
Our final source from Money Week on MSN pointed to a worrying trend. Divorce financial settlement fights surge, why it pays to agree terms early, why the surge in conflict.
Or to the research, it's largely down to economic pressures. Two main things. Tax increases affecting how assets get split, and significant drops in the actual value of assets like homes or investments.
So the pie is shrinking or the cost of slicing it is going up.
Exactly. When there's less overall value to divide or taxes take a bigger bite out of it, people understandably feel they need to fight harder for their share to be financially secure afterwards.
Makes a bad situation even harder. What's the typical process for sorting this out legally?
Well, the commentary described it as a formal legal process. You have to divide property, figure out child custody, maybe alimony, handle debts, and crucially, any agreement needs a court stamp of approval to be legally binding. It formally redraws those financial lines.
And how do those falling asset values specifically make things more contentious?
Think about it. If house prices or stock portfolios are way down, there's just less perceived cushion. When values were high, maybe there was enough for both people to feel okay-ish. But when the total value drops, as the sources noted, securing what feels like a fair share becomes much more critical, leading to tougher negotiations and more conflict.
It feels more like a zero-sum game.
Pretty much, yeah.
Yeah.
The sources also really stress the value of financial literacy here.
How so?
Getting educated about your finances before or very early in the divorce process is vital. Understanding how assets are actually valued, what the tax hits will be for different settlement options, figuring out a realistic post-divorce budget.
Knowing the numbers helps you negotiate better.
Absolutely. It equips you to be more realistic, negotiate more effectively, and potentially reach a fair agreement faster, avoiding those long, drawn-out court battles.
So financial understanding can actually smooth the path, even when things are emotionally fraught. What happens financially if those battles do drag on?
The long-term impact is really negative, based on the research. Savings get depleted by legal fees, the sheer cost of the fight eats away at whatever assets there were, and it can lead to lasting financial instability for one or both people.
Ouch.
Yeah. So, reaching an agreement, even a difficult one, is almost always better financially in the long run than fighting endlessly.
That's a really sobering point. A strong financial reason to try and find common ground.
It really is. The financial cost of conflict can be huge.
Wow. Okay, we have covered a lot of territory today, haven't we?
We really have.
From the nitty-gritty of Fed rates hitting your savings, that CD versus high-yield choice, untangling mortgage rate moves, all the way to planning for retirement decades out, and navigating the financial side of divorce.
It's amazing how interconnected it all is, isn't it?
Yeah.
And how much those big economic waves shape our personal financial shores.
Totally. And hopefully diving into these specific sources has maybe made some of these things a bit clearer.
Yeah, maybe give you some practical things to think about for your own finances.
We definitely want to thank you, our listeners, for providing the sources that fuel these deep dives. Just a reminder, all these insights came compiled in the Consumers 360 News Commentary, drawing from the consumers.app aggregator, dated June 10th, 2025.
And please do like, share, and subscribe Consumers 360. It helps keep these kinds of insights coming.
So as you think about everything you commemorate, market guesses, moving mortgage rates, competition, working in funny ways sometimes, how vital financial know-how is in big life changes. Here's a final question for you to chew on. Looking at your own financial lore right now, single idea from today feels most relevant, and what's maybe one small thing you could do based on it?